Okay, so there's something really strange playing out in Detroit right now. You've got America's biggest automakers posting these unbelievable, record-breaking profits, but at the very same time, they're laying people off. On the surface, it looks like a boom. But the real story? Well, it's a whole lot more complicated. The whole story really kicks off with this massive contradiction. I mean, on one hand, you have GM and Ford posting earnings reports that are so good their stocks are just soaring. But then, on the other hand, GM is turning around and announcing layoffs for hundreds of their workers. How does that even make sense? So this is the big question we've got to answer. How can a company be doing so well financially with a stock price that's climbing while at the same time telling its employees they're out of a job? Let's unpack the real story playing out in Detroit. To solve this puzzle, you have to do one thing: follow the money. And right now, that money trail leads straight to some very big, very profitable, and very traditional gas-guzzling vehicles. Yeah, this huge success isn't coming from those futuristic electric cars we hear so much about. Nope, it's being driven by this massive, ongoing demand for old-school, gas-powered vehicles. We're talking about the big iron here. Full-sized SUVs and trucks like the Ford Expedition and the Chevy Tahoe. These are the vehicles that are just flying off the lots. And let's be super clear, we're not just talking about a good quarter or a pretty good year. For these specific gas-powered vehicles, sales are at a level these companies haven't seen in 2 decades. It is an absolute, undeniable profit machine. But, this boom in truck sales, it's only part of the story. The second piece of the puzzle is a pretty clever, pretty aggressive competitive strategy. It's not just about selling more of your own cars, it's also about making it way harder for your rivals to sell theirs. This strategy has become so direct that it's been described as GM and Ford essentially ganging up on their main rival, Stellantis. That's the parent company of huge brands like Ram and Jeep. So here's how this 3-step play actually works. First, new tariffs get put on trucks that are made in Mexico. Okay, now for step 2, it just so happens that a key competitor, Stellantis, builds its super popular Ram pickups right there in Mexico. And the result? Well, that's step 3. Stellantis gets hammered with a much bigger tariff bill, which hands a major cost advantage right over to GM and Ford. Pretty slick. And this brings us to the final piece of the story, and it's the part that directly explains those layoffs. It's a huge strategic pullback from what everyone thought was the future: electric vehicles. After years and years of bold promises and throwing billions into investment, both GM and Ford are now very publicly hitting the brakes. They're actively and openly stepping back from their big electric vehicle commitments. And what's interesting is, while they're both pulling back, they're doing it for slightly different reasons. For GM, who's actually further along in production, the problem is just a real disappointment in sales. The demand just isn't there. For Ford, it's more about the bottom line. They're simply losing so much money on every single EV they manage to sell. A key driver of the early EV demand, the thing that automakers were betting on, was that big $7,500 federal tax credit. That incentive made the much higher sticker price of an EV a lot easier for people to actually swallow. Well, that incentive is gone now. And with it, a major pillar that was holding up EV demand has been kicked out from under the market. Without that credit, the real, unsubsidized demand for electric vehicles has turned out to be much, much weaker than anyone thought. So, let's connect all the dots here. You've got record profits from gas trucks, a smart tariff strategy to kneecap a rival, and a major pullback from super expensive EVs. You put it all together, and that weird paradox we started with, it finally starts to make perfect sense. From Wall Street's point of view, this is a winning formula. Step 1. Maximize profits from the gas guzzlers people are actually buying right now. Step 2, use tariffs to hurt your competition. And step 3, cut your losses on that expensive, money-losing EV bet. That is the formula that's driving their stocks through the roof. When you really boil it all down, this is a simple, classic business choice. You focus on the guaranteed moneymakers of today rather than pouring billions and billions into the costly, uncertain bets of tomorrow. And the layoffs, well, they're the direct result of scaling back on those future bets. So this leaves us with one final and pretty provocative question. Is this a brilliant short-term pivot that maximizes profits today? Or is it a really risky long-term gamble that could leave Detroit far, far behind when the EV transition finally, inevitably happens?
Only time is going to tell.